Hello, my name's Anita Monteith. I'm a technical manager with the ICAW Tax Faculty. Welcome to the October edition of TAXtalk, and this is going to be a Budget 2018 special. With me today, I have Ross Campbell, who is Director of our Public Sector. Welcome, Ross.
Thank you, Anita.
And Frank Haskew, who is Head of the Tax Faculty. Welcome, Frank.
Thank you, Anita.
Perhaps I should say welcome back, Frank. You are a regular.
Glutton for punishment.
Now, today we're going to be talking about the headlines, the top lines of what was announced in Budget 2018. We will be having a webinar in a couple of weeks' time, which I'll remind you about at the end of this, where we'll be, having poured through all the finer print, we'll be covering the details of the new rules. But what we thought this year is that we'd get you in, Ross, so that we can talk about both sides of the finely balanced fiscal equation. We often talk about where the money's coming from, but you're really here to talk about where the money is going to.
Indeed.
So, in your past life, you were a senior Treasury civil servant. How do you feel about this Chancellor's performance?
Well, I think what we saw yesterday was actually a little bit of political theatre, which gave the illusion of probably a more generous budget than has actually been the case. And over the next 5 years, public spending is set to rise from about where it is today, around about 812 billion per annum, to around 955 billion per annum. Now, that sounds like a big increase, but actually that's pretty much remaining stable as a proportion of the economy, around about 38%. So really all we're seeing is public spending keeping pace with economic growth.
So the money that was promised for the NHS, do you see that being spread through the next few years?
Well, I mean, the Chancellor's allocated the first 2 billion of that 20 billion for the NHS for this year. However, really, most of his big public spending decisions have been pushed off till next year's spending review, which will probably report, I would imagine, just about before next year's budget. We're seeing about 1.2% growth across the board in public spending thereafter, of which, of course, the NHS will get the biggest share, with public spending having increased through policy decisions by about 30 billion in 5 years' time, of which roughly 2/3 will be for the NHS.
Right. And I know you were very concerned about cybersecurity and defence spending. Has that
There's
brought money?
a little bit of help for defence, $1 billion for this year and next year up to the spending review. I think defence isn't quite as large as health in its ability to consume money, but I suspect there's some needy causes in defence. You mentioned cybersecurity, and of course the new successor nuclear deterrent is certainly consuming quite a lot of money at the moment.
Indeed. Well, Frank, you've been looking at where the money is going to come from, and I know you love going through the Red Book and looking for the really big numbers. So, what are your top lines?
Well, of course, it works both ways. Some of this is, tax reductions. Other amounts of it are tax raising, but the obvious big ones are some of the tax reductions, really. So, the big one, of course, was personal allowances and bringing it forward effectively a year, but I know we'll come on to that. And that's effectively going to cost about 1.5 billion a year, so it's a fairly chunky figure. Other big numbers in the Red Book are the changes to, we'll come on to capital allowances and capital expenditure generally, and that's about another £1 billion or so, give or take.
You're talking about billions. Everything is just huge, isn't it?
Well, not always. We've also got, of course, something very close to your heart, Anita, which is the IR35 extension.
3 billion all on its own.
3 billion, but that's over the 4 years from introduction, so it's sort of not quite, it's not per annum. And of course, business rates, which again we'll come on to, and at the moment that's effectively another £1 billion over 2 years.
Okay.
And there are lots of other ones, but most of them are sub the billion, so to speak.
minus more chicken feed. Let's just pick through some of that in a little bit more detail then. You mentioned capital allowances. If we look at the business effects first, one of the old favourites seems to have made a comeback.
Are you referring to the structures and buildings allowance by any chance?
I am. I want to call it the industrial buildings allowance.
But it's not just industrial. Or agricultural, of course, was the other one.
That's what they used to be.
Yeah. But effectively it's like a reintroduction almost of the old industrial buildings allowance.
But rolled up into lots of other buildings too.
Well, effectively, I suppose it's recognising that the modern economy isn't just about lots of factories. Potentially it's the capital cost, effectively it's the capital cost of a building, but excluding the land, of course. And you'll be able to get a 2% effectively straight down writing down allowance. So even I can work out, I think, that effectively you'll get the tax relief for the cost of the building over a 50-year period, whereas of course before you wouldn't get anything.
No, well, it sounds very generous and hopefully will encourage people to rush out and buy a lot of new buildings. Ross, when you were in business, did you find that these incentives encouraged you to go out and spend?
Well, I think what they do is they accelerate already planned spending. I think businesses tend not to spend money on things they don't actually need, but what it does sometimes do is it encourages already planned expenditure to be done a little earlier. And of course, in a way, what the Chancellor's trying to do is bring forward spending to stimulate the economy, which in turn flatters the public spending figures and flatters the national debt.
Well, the annual investment allowance was another one you picked up, Frank.
Yes, but actually just before we finish on the structures and buildings allowance, it's probably also, there's another side to this coin, which is the reduction in the effectively plant and machinery allowances for long life assets, down from 8% to 6%. So he's giving on the one hand with the new structures and buildings allowance, SBA I think, isn't it, is what we're going to be calling it. It sounds like a beer, doesn't it, really?
Well, I hadn't thought that, but yes.
The other side of the coin is there's going to be a reduction in the long life capital allowances. And if you look at the Red Book, which of course I'm sure you have, the numbers actually, I wouldn't say they net out, but there's not a huge amount of difference between them. No, so the SBA isn't quite as generous as perhaps it might appear when you take into account the reduction in the long life assets as well. Interesting. So on the annual investment allowance, well, we've been round this one a number of years since it was introduced, haven't we? Because it goes up, it goes down.
That's why I couldn't wait for you to get to it. It's the bouncing allowance.
Yes, it sort of goes up and down depending on which Chancellor I think is in which flavour of the month it is at the moment. But so the plan is that it will go up from 200,000 to $1 million. And effectively, we would have once called it 100% first year allowance for plant and machinery. That's what effectively it is. And that's going to apply for a 2-year period starting on the 1st of January 2019. So you've got 2 years in which to spend £1 million effectively.
Dig deep and spend.
Dig deep and spend.
And we will be going through the calculations for that on the webinar that I mentioned earlier, just to remind you of some of the awkward aspects of having a bouncing allowance. Frank, corporate capital gains, that's also come in for a restriction I noticed in this year's budget. So we've had in the last few years a move by the government to restrict the ability to offset losses, to begin with, trading losses against trading gains. And having introduced that now, what we're seeing is that those rules are going to be extended to corporate capital gains as well, which previously they weren't. So effectively it's all going to be bought really within the same regime. So the restriction on offsetting future capital gains will be limited to 50% effectively. Interesting, and it looks rather like the £5 million exemption will be there for smaller businesses, although anyone looking at this week's Newswire will see that you do actually still need to claim to get your £5 million, even if you are a small business, and I imagine that that's going to apply here to set off of capital losses.
I'm sure it will.
Yeah.
I'm sure it will.
Let's move on now to business rates. Been a lot of controversy over business rates, Ross. What is your view on what the Chancellor has done in this budget?
Well, from the Treasury's perspective, business rates have actually been a very successful tax, and I think by next year raising in excess of £30 billion per annum, which makes it quite a big tax. Of course, there's been a lot of noise from the high street and businesses generally about the impact on profits that such a large amount of tax is having. And of course, the Chancellor has offered some protection to smaller businesses, though when you consider that the cost of that protection is about 500 million per annum, you can see that he's not actually taking much less in the total business tax take. I bigger businesses are still going to be pretty heavily exposed to business rates.
Right.
I think the numbers are that 90% of businesses, the Chancellor is saying, or premises will benefit. But the 10% obviously will be the big retailers, and they won't.
And of course,
So the small high street shop will benefit, but the very large ones won't.
Indeed, if you're Tesco, there's not much good news for you here, because you're clearly going to be caught still by the full extent of this.
And of course, they are the largest employers, aren't they?
I think they're the largest private sector employer in the UK. Yes.
And of course, it is again temporary. It's only for a 2-year period. So, what will happen at the end of the 2-year period?
Well, hopefully the money allocated to revamp our town centres will have made a huge difference. We'll all be going there to do other things as well as shop, so there'll be...
Yes, I mean, the only thing I'd add is this is a tax that's crying out for reform as the nature of business and business occupation changes. We've yet to see any real appetite at the Treasury, though, to see it reformed.
Yeah, I think one of those that's going to run and run. It's very, very political, isn't it?
It is, yes.
National insurance, talking of political taxes, Frank, the employment allowance, what's happening to that?
So the employment allowance was introduced a few years ago to effectively help small businesses with their national insurance bill. And it was originally introduced at effectively a 2,000 allowance, and then it was increased to 3,000. But it was available to all businesses, large and small, and the Chancellor has now effectively is going to stop it for larger businesses. So if you've got a employer's national insurance bill of more than 100,000 in the previous year, then effectively you won't be able to get the employer's allowance from now on. I think that April 2020 is so we've got a little bit of a lead into it.
It would be interesting to see how that works, because presumably it will have to be done through the RTI system. I know. We're still waiting for the post-implementation review to be actioned. Class 2 national insurance, that's continuing. That's already been announced, but that's going to be maintained throughout the life of this Parliament.
I think having had his fingers burnt on national insurance contributions for the self-employed, I think the Chancellor is clearly reluctant to go too near national insurance contributions.
What about entrepreneurs' relief? We should really talk a little about capital gains tax, since there were a few changes in this year's budget.
Yes, there were. So firstly, I was pleased to see that he has made the change that if you need more than 5% to trigger on entrepreneurs' relief, so that's your threshold. And of course, some people, when you're getting recapitalisation, dilution shares,
yes.
Then you could go below 5% and you could lose relief. So effectively now, if you go below, your entrepreneur's relief will be crystallised, if you like, when you go below, so you won't lose it.
Yes, there was some consultation on that.
There was, and I would just thank some of our volunteers for all the sterling work they did, and it's good that the Chancellor's listened to that. But of course, there's the quid pro quo again, which is that the he's going to extend the qualifying period for entrepreneurs relief. So currently you only need to hold shares for 1 year, and that's going to be increased to 2 years. And also, going back to the sorts of things we remember from even older days, the 5% is currently just on the share capital. He's going to make that test more restrictive, so it's also going to be by reference to the assets and the profits. So you need to have 5% of each of all of those.
Yes, this is what the old anti-avoidance rule, isn't it, being extended? So it's always a bit surprised that they didn't do that in the first place to this one, but
I think that there was a bit of surprise that wasn't introduced earlier on. So once again, never throw your old tax books away, because everything
it just keeps
back.
Coming round. Okay,
keeps Tollies in business.
It does.
Yeah.
Now, as we mentioned, national insurance. Of course, national insurance is probably behind IR35, and surprise, surprise, we see in this year's budget that the IR35 changes that we've now had for 2 years nearly in the public sector are going to be extended to most of the private sector. I suppose we should say up front that there are a lot of problems still in the public sector. We have discussed those with HMRC, and they are being addressed insofar as it's possible to do that. Are we ready for it to be extended to the private sector, though, Frank? What do you think?
Well, I think there was a lot of concern that it was going to come in April 2019, so at least we've got a year and a half almost to get ready, because I think it is going to be a major change for the private sector. And I know I was speaking to head of our business only yesterday, and he was saying we've got to help our members and businesses get ready for this, because this is a major change. So I think the extra time is welcome, because I think otherwise people would have really struggled to get all this in place, particularly with things like, we've got making tax digital for VAT, sort of all going on.
I knew we wouldn't get through this without talking about MTD and Brexit, of course, that's the other one. But Ross, as a former public sector employer yourself, the way it seems to have happened in the public sector is that, I don't know whether the memo went round, you've actually got to bring as many people onto the payroll as you can. Do you think that that's really how it happened?
I don't think, certainly the coalition government made quite a big deal about government departments not employing contractors if they could avoid it. That's not to say they wanted to see the employee payroll go up either. But there was a sense that contractors were being overused in government, and many people were leaving government, becoming contractors, having had a payoff, and then benefiting through a more benign tax regime. And I think it was very much seen as something needed to be done to level the playing field.
Good. Right. So we are extending it to the private sector. As you say, Frank, we have got a little bit of extra time, and there are some very big numbers attached to this.
Well, we mentioned earlier on, but over the 4 years from 2020, the forecast is basically £3 billion. So it's a material amount of money.
It's a material tax-raising measure, certainly.
One thing that interested me is as a result of the consultation, I think, the government has appreciated that it is a difficult thing to educate employers to the IR35 rules, how to apply the rules about whether someone is an employee or like an employee or a self-employed person. So what they've done in announcing this is to exclude small employers. I think that's an interesting challenge. For a start, actually having a split system in the private sector will be interesting. I don't think we have that in very many places. And there's going to be, as you say, a massive education programme. I know that we will be stepping up and we will be doing some webinars. I think we'll have to take it from the bottom, what is IR35, and we just throw this term around, all the way through how do you account for it, and the slightly awkward thing of what happens when it goes wrong. We'll be looking at the consultation that has been promised and tackling that in due course.
It's been a big challenge implementing this in government. I suspect it's going to be an even bigger challenge doing it in the private sector.
Yeah, well, I'm glad they've left it till 2020 because we've got quite a lot happening in 2019 and we do need a little bit of extra time here. VAT, we just move on to VAT, Frank. We feared the worst, but...
Well, I have already mentioned making tax digital for VAT, of course, on the 1st of April 2019, so that's going to be the major thing coming up for businesses. But there was quite a bit of speculation about the VAT registration threshold potentially being reduced. I have to say my personal view, I think, given where we were, I thought that was unlikely to happen. So the Chancellor's probably made a very pragmatic decision, which is that he said initially last year that he was going to freeze it for 2 years, and he's now said that he's going to freeze it for a further 2 years, so up until April 2022. Interestingly, that actually does start raising quite a bit of money by the end. It's something like £150 million by keeping the threshold.
There's all those businesses that are floating up and into the VAT net.
Well, inflation alone will do it.
Yeah,
indeed.
So it is a revenue raising measure. But yes, it's not going to go down for the foreseeable future, well, for the next 4 years.
There was another change announced, well, in fact it's been consulted on this summer, which is the reverse charge in the construction industry. I think that's going to raise a fair old bit as well, isn't it?
Well, actually, I'm not sure that the Red Book's very clear on how much that's going to raise, because it's more of a sort of missing trader fraud type of situation. But effectively, missing trader fraud, MTIC fraud, as we had a few years ago, was quite massive numbers, and it sounds as though that had leached over, if you like, into the construction industry, where effectively people were charging VAT, and then before you paid it over, you disappeared. So what they're going to do is what they did previously to address some of this elsewhere, which is to introduce a reverse charge.
So the subcontractor will charge themselves VAT?
Yeah, so there's no VAT being charged, so potentially you can't recoup it. So I mean, it remains to be seen whether it will actually achieve the objective of reducing fraud in the construction industry.
Yeah, I'm a bit concerned about the admin burden there. It does seem, I mean, it's not an intuitive thing for somebody who is laying the cabling within a large office block complex to realise that they've got to do.
Well, I think, I'm not a VAT expert, but when you look at all the list of things that are included and then all the list of things that aren't included, as a bit of a VAT layperson, you just looked and you thought, which one would you ever really know which one you're in?
Well, I remember I did some work in the construction industry scheme when it was changed a few years ago, and I do remember being staggered at whether making a difference what type of floor covering you had and how it was stuck down or not stuck down.
But for instance, security systems, they're not within it. So you'd have said that they were part of the construction, I would have thought, but
perhaps there's less fraud associated with security. If you care about security, you may not be into fraud. Who knows? Who knows? Well, forging on, I think we should look at personal tax. The personal allowance, surprise, surprise, gone up a year early.
Yes, and as we said, that potentially is going to raise it's going to cost 1.5 billion a year. But he's actually then going to freeze it for the following year, which I thought was quite interesting. And then I think he was going to index it probably from there on. But of course, that effectively would claw some of the money back, I guess. Probably, certainly, the personal allowance has gone a long way from where it was when the original government came into power with the manifesto proposal to raise it to 12,500, and he's achieved it a year early.
And the 50,000, the point you can now earn 50,000 before you start paying high rates of tax. Although you're a Scot, Oh, you're not?
I am, yes, and oh my goodness me, it's far more complicated north of the border these days.
It is. Well, we probably better not get too dragged into that, but I foresee complexity ahead.
Indeed. I think the only other thing I'd add to this, of course, is it changes the tax base and it shrinks the income tax base and, of course, places the burden disproportionately more on higher and upper rate taxpayers. And that, of course, means that the government is more exposed to a smaller group of people for its income, which shouldn't be forgotten.
Very good point, yes. I almost feel like a drink at this point, so we can swiftly move on.
The Chancellor's been generous there.
Move on to duties. We have the beer, cider and spirit duty freeze, do we not?
Well, I'm sure that's welcome for the Real Ale Society and the Scottish whisky industry, of course, which are domestic, though for wine drinkers, not so much fun, but we don't make so much wine in the UK, I guess.
No, although as a wine drinker rather than a beer, cider and spirit drinker, I do feel a little...
Mine's an SBA.
Do you get a building with that?
A free building. Don't forget, of course, the fuel duty freeze as well, which...
yes, that's interesting. It's just gone on forever.
9 years or something?
This is almost an example of a tax that seems to have become too political to change. And I think here the Chancellor is speaking very much to Theresa May's just about managings. The households that are heavily dependent on cars and for whom putting fuel in cars is quite a big outlay in the household finances. And I think in the terms of sort of keeping these potentially Conservative voters on side, this has become too political to touch.
It's interesting. I remember when I was younger, my parents used to rush to the petrol station to fill the tank up on budget day before the rate went up. That's it. You'd have to get there, but
You're
that
showing our
doesn't
age, Anita.
Oh, wait. Oh, right. Okay.
No, I remember that too. Not so old.
Okay, well, let's move swiftly on then to capital gains tax. Frank, principal private residence relief, few minor changes there.
Yes, so sort of tightening up again of the principal private residence. So firstly, the period at the end where you had an 18-month period that effectively you could always claim is going to be reduced to 9. Of course, originally it was 36, wasn't it?
It's just gone down and down.
So it's being shrunk slowly. And the other thing is lettings relief, where effectively you can claim, I think it's at 20,000, I think it is.
40,000.
40,000, sorry.
Well, it used to be. I don't know if it's gone down, I don't know.
But now the requirement is going to be that you also need to be in the property where this is being let, so that wasn't the test beforehand. So that is tightening it up. And I don't have the Red Book figure in front of me immediately, but surprisingly, I think that could bring in, quite a fair amount of money.
Yeah, I had no idea so many people used letting relief, but clearly they do. In fact, I spoke to Sue about it, Sue Moore, who's our private client specialist, and she's going to pick that one up in the webinar in a couple of weeks' time. I think it's quite important that we mention that the capital gains tax payment window is going to be closed for people with second homes.
Yes, so effectively you're now going to have to make a payment on account within 30 days of selling the property. So of course currently, as we know, if you sell an asset with capital gains tax, the capital gains tax is due on the 31st of January following the tax year that it occurred in, or the disposal. So that's quite a major bringing forward. Of course, it's already been introduced for non-residents owning UK property, but it has made some relaxations to it following consultation. So effectively, you will be allowed reasonable estimates in calculating this.
So if you think you've got a loss, for instance, then...
So that at least will help, I think, to ameliorate some of this.
Okay, well, it'll be interesting. I guess it will be frequently the solicitor or surveyor.
Well, the surveyors will be involved in it, won't they?
But probably more.
Conveyancing solicitors, I think, have tended not to deal with this. I mean, there's been a lot of problems, of course, with non-residents not even realising.
Yes.
So my guess is that this, conveyancing solicitor will probably say, well, I'm not giving tax advice, so you'll need to go and
see your accountant. Well, that's never a bad thing. But in the amount of time we have left, perhaps we could just turn to tax avoidance. We've got a few changes there, haven't we? Is HMRC becoming a preferential creditor for insolvency? How do you feel about that?
Well, of course, it always was once upon a time, and then that was taken away, I think, in the Enterprise Act
A long time ago. Yeah.
But effectively, it's going to be reintroduced, but only for tax debts that effectively most people would have thought ought to have been paid over. So, for instance, PAYE. So, most employees would think, employees would have thought that their employer
PAYE
paid
had
that
been
over.
paid over, yes.
And effectively, that's going to be, HMRC will be a preferential creditor for that, and also VAT and
So where a
industries.
business may have collected money from third parties, I suppose, if they haven't paid it over, HMRC can stand first in the queue.
Yeah. But not for corporation tax.
No,
so
not for your own tax.
No. So I think there was a concern it's going to be all taxes. So to some extent it's more benign than perhaps a lot of people fear, but clearly HMRC will be in pole position on those taxes.
Yeah. Well, yes, the issue I think that's concerning some people is that it will encourage HMRC to push people into insolvency. But then there are those who want to be pushed into insolvency because it costs money to make yourself bankrupt. I know that Caroline Miskin is going to be talking about this one on the webinar in due course, so we will be coming to that in the future. So, just to wrap up then, we haven't talked about the new digital services tax. Big number attached to that.
440 million, I think, a year.
Yeah, so less than $1 billion.
Less than $1 billion. Surprisingly small, actually, I think.
Yes, I mean, I think everybody thought the Chancellor was probably going to go after online companies, and this is almost slightly perplexing in that if you were going to do it, you would have thought you would do it for reasonably large amounts of money rather than relatively small ones.
He hasn't gone for the sale to the consumer, though, has he? Which people were concerned that he might do.
No, well, I think that came out of the consultation that that wouldn't have been politically, I think, acceptable. But it's going to be interesting to see how, in practice, these things are going to be collected. I mean, that was always an issue with this, and I think it still is.
I think there are going to be an awful lot of things that are going to be interesting to see how they unwind over the coming months. So we may get another budget in the spring. Who knows? Depends what happens on Brexit. But in the meantime, I think we must wrap up our chat on today's budget, and let's look forward to the webinar. Please do join us again. Our webinar is scheduled for the 16th of November, and you can reserve your space for that on the icaw.com website. Thank you very much for joining us today, and thank you to my guests, Ross and Frank.
Thank you.
Thank you.
Thank you.